This is one of my most successful scalping strategies. It involves capitalizing on news releases, understanding liquidity dynamics, and the art of anticipating stop hunts. Let me break it down for you. Before a major news release, the market is often in a state of anticipation. Traders are positioning themselves based on their expectations, creating potential liquidity zones. And these zones act as magnets, attracting both limit orders and stop orders. Your task is simple. Before a major news release, move to the 5-minute chart and mark the most obvious liquidity levels where the market is likely to react. Now, here's where the market psychology comes into play. When the news hit the wires, there's often a sudden surge of volatility. This initial move is often deceptive, as it's driven by a flurry of orders triggered by algorithms and reactive traders. You probably lost quite a few trades during these conditions. The reality is that this initial reaction is often unsustainable. This is where the stop hunt begins. After a news release, the market will often make a sharp move in one direction, triggering the stop orders placed by unsuspecting traders. These stop orders act as fuel, propelling the price further in that direction. The big players, who have anticipated this move, will often take the opposite side of the trade, absorbing the liquidity provided by the triggered stops. And as the stop hunt unfolds, the market reaches a point of exhaustion. This is where the trap is set. The price reverses sharply, catching the traders who chased the initial move. They now find themselves trapped in a losing position, forced to exit at unfavorable prices. In our strategy, this is your moment to shine. By anticipating the stop hunt and the subsequent trap, you can position yourself to enter the market in the opposite direction. You're essentially scalping the wave of liquidity as the trapped traders scramble to exit their positions. Scalping news releases was very different 15 years ago, and I had a different strategy. 30 seconds before the event, I placed 2 pending orders. One was 10 pips above the current price, the other 10 pips below. Then I just waited for one of the orders to trigger. There was a time when this scalping strategy really worked. But these days, making money by scalping news is tough. With the advent of high-frequency trading algorithms, the reaction to news events has become more complex and less predictable. Nowadays, when a major news event is released, there is often a flurry of activity in the market. The price will spike in one direction, only to quickly reverse and then spike in the opposite direction. It's no longer a simple matter of placing pending orders and waiting for the expected move. That's why it's much better to exploit the price spikes after the news release. As I said before, the first step is to find most recent liquidity zones. Before the news announcement, you analyze the lower charts to find the most obvious and nearby liquidity zones. You want to mark those price levels where there is a significant concentration of pending orders. These zones are often found at major supply or demand areas, round numbers, or at previous swing highs and lows. When the news is released, you wait for the sudden surge in volatility as market participants react to the information. This volatility will most likely trigger a stop hunt, where the price rapidly moves in one direction, triggering stop-loss orders placed by other traders. This stop hunt is designed to flush out weaker hands and create a temporary imbalance in the market. Once your zone is hit and the stop hunt occurs, and you see signs of rejection on the 1-minute chart, you aim to enter a trade in the opposite direction of the initial price spike. The idea is that after the stop hunt, the market absorbs the news and regains equilibrium. The placement of stop-loss orders is a critical aspect of this scalping strategy. Traders often place their stop-loss orders at obvious zones, anticipating that the price will reverse before reaching those levels. But you know that market makers and large institutional traders have other plans. They are aware of these common stop-loss levels and will deliberately push the price to trigger these orders. And the impact of these liquidity runs on the market depends on various factors, such as the significance of the news, the deviation from market expectations, and the overall market sentiment. To make it even easier, I recommend you add the live economic calendar indicator available on TradingView. The indicator integrates real-time financial news directly onto your charts and is designed to keep you informed about upcoming and past news events. It basically displays future news in real time. You don't have to check other sources because the next major releases are plotted right on your charts. The live economic calendar covers a wide range of financial news events. Each event is categorized based on its expected impact on the market. That's why the indicator uses a color-coded system to differentiate between low, medium, and high-impact events. News events marked with a white color indicate a holiday or a period of low trading activity. News events highlighted in yellow are considered to have a low impact on the forex market. These events, while still noteworthy, are not expected to cause significant price movements or generate substantial trading opportunities. Orange-colored news events are classified as having a medium impact on the market. These events are expected to generate moderate price movements and trading activity. These can potentially influence short-term price action and provide trading opportunities. News events marked in red should be your main focus, as they are considered to have a high impact on the market. These are the most significant and closely watched events that have the potential to cause substantial price movements and increased volatility. High-impact events often include major economic releases like non-farm payroll data, GDP figures, and central bank interest rate decisions. With this indicator, vertical lines are plotted on the chart to represent both upcoming and past news events. Lines in the future help you anticipate and prepare for upcoming events, while lines in the past enable you to analyze and backtest the impact of previous news releases on price action. By integrating news events directly onto the chart, this indicator saves you lots of time in manually searching for and tracking economic news. We are monitoring euro-dollar pair, weighting the unemployment claims and advanced GDP numbers. Before the news announcement, we marked the most obvious and nearby liquidity zones, the areas where we expect a lot of stop orders to be placed by other market participants. When the news was released, there was a sudden surge in volatility to the upside. In this case, the price initially spiked upwards, likely triggering a lot of buy-stop orders. However, the price quickly reversed and started moving down. This is a classic sign of a stop hunt. The big players pushed the price up to trigger the buy stops and then quickly sold into the artificially inflated prices. Once our liquidity zone was hit and we saw signs of rejection, the correct move was to enter a trade in the opposite direction of the initial price spike. So by entering a short trade after seeing this rejection, you are essentially positioning yourself with the big players. You are anticipating that the initial upward move is a trap and that the true direction of the market is likely to be downwards. We are now looking at the gold 1-minute chart for the Federal Reserve statement release. We see that leading up to the announcement, gold was trading in a relatively tight range. This suggests that market participants were likely waiting for the news before committing to any significant positions. We mark the key liquidity levels on either side of the current price, the areas where we expect a lot of stop orders to be clustered. As the statement hit the wires, we see a sharp downward move, which was quickly met with significant buying pressure. This suggests that the initial sell-off was indeed a liquidity grab and that the real sentiment is bullish. This is our cue to enter a long position. By going long after the strong rejection of the downward move, we are aligning ourselves with the underlying bullish sentiment. The fact that prices not only recovered, but also surged past the pre-announcement levels is a strong indication that the market interpreted the statement as gold positive. We are looking at Dow Jones Industrial Average 1-minute chart, waiting for the release of the core price index. Before the news announcement, we identified the most obvious liquidity levels where traders were likely to have pending orders. As the core price index hit the wires, there was an initial upward move. At this time, we don't know if the price will continue to go higher or reverse, but our plan includes shorts only. We hope this move is a temporary illusion of buying pressure. Once the buy stops were triggered and the liquidity was absorbed, we saw signs of rejection. This is where we look to enter our short position. This rejection candle on the 1-minute chart is our signal that the stop hunt might be over and that the real market sentiment is likely bearish. As always, risk management is crucial. A logical stop-loss placement could be just above the high of the rejection candle. This allows the trade some room to breathe while protecting us in case the market suddenly reverses higher. Of course, scalping the news on a 1-minute chart requires practice and adaptability. You should familiarize yourself with the characteristics of different currency pairs or indices and how they react to specific news events. It's also essential to be flexible and adjust the strategy based on market conditions and the specific news announcement. It's also important to note that this strategy requires quick reflexes and decisive action. You need to be ready to pull the trigger as soon as you see the rejection at your key level. Hesitation can be costly, and you will miss your entry if you're not prepared. This scalping method is truly one of the best ways to capitalize on the volatile moves that often follow major announcements. But if you want other scalping techniques to use in other market conditions, go ahead and watch one of these videos.